Hello everyone and welcome to the Do More With Your Money podcast, episode 211, your guide to tax year end. So obviously we're getting to very close to tax year end, which is a very busy time for us as a business, but also a very busy time for clients to make sure they've used those allowances. Just going through the panel today, I'm joined by Donald Sunboy.
Thank you.
Yeah. Good to see you, Donald. I think we've done a couple together now.
Yes, we have.
It's always the better ones, I think, when you and I are together. Do you agree?
Absolutely.
Brilliant. I'll introduce Craig Armand first, because I know everyone knows Craig. Craig, Head of Technical Planning, and Rachel Sage, which is your first podcast?
It is,
It
yes.
is. Client Relationship Team Leader. So everyone else has done a podcast before, Rachel, but I think you're going to have to just introduce yourself a little bit and tell us what you do.
I am, yeah. So I am part of the relationship management team, and we look after clients and make sure that they're supported through technology, utilising their allowances, making sure that they're getting booked in with financial advisors, and just being at the other end of the phone for any kind of help that they need. And we play a big role in supporting in a daily basis, so it's really nice to kind of get involved in that way.
Yeah, totally agree. I've obviously witnessed quite a lot of your work over the last 2 years, and it's all positive in my opinion. You're brilliant with clients, so we're really delighted to have you on today to talk about this. So let's start off. Let's go through, we've got the title here, which is Rules and Regulations, which is a sort of daunting title. But just before we go into what allowances are available and what clients should be thinking about, Donald, I don't know if we can we talked about the budget now as part of that budget session, so I don't think there's anything too exciting about the budget, but is there anything we need to be aware of when we're looking at tax year end?
Well, generally, in terms of the budget, at least the spring budget 2024, we kind of think it didn't really deliver much. Yeah. But in terms of pensions and ISA, just the two things, at least the further 2p reduction. Yeah. We know that in national insurance. So essentially, if you're earning £35,000, you could save in a yearly savings of about 700. But if you adjust that for inflation, that brings it down, as we know. Yeah. Then you have the new all singing, all dancing British ISA. So that will still need to go into consultation, but essentially there could be about 5,000 left, an additional 5,000 over the 20,000 which clients have got. But the main changes for 2024-25 tax year end actually came in the spring budget 2023, which is there are two essential changes really to pensions. So the first being the removal of the LTA charge, so that's Lifetime Allowance charge. So for the current tax year, that's ongoing. But the main one for 2024-25 really to talk about is the abolition of lifetime allowance, essentially. So we've had 18 years of lifetime allowance, lifetime allowance as the current framework. And just
to dig into a bit of that, because some of our clients will maybe not be fully aware what that is, and some will be because they'll have certain protections. So just give me a bit of detail. What is lifetime allowance in terms of your pensions?
Essentially, lifetime allowance is the maximum you can put into a pension scheme before you get taxed. But you could put any amount you want in a pension scheme in theory, so you could do that. But for you to get tax relief on that, so the maximum level you could go to essentially is the lifetime allowance. So that's been changed into a new structure called, so you're taking a framework that we've known in 18 years and moving it into a new framework, which is called, so anything you take, if you want to take an income from your pension or lump sum or anything, it's now called a relevant benefit crystallization event. So what that does is introduces two new framework now. So you have the lump sum allowance. So your lump sum allowance will be pegged at 268, 275. So a lot of people will know that's about 25% of the lifetime allowance, 1073, 100. Then you have the second one, which is the lump sum and death benefit allowance. So which is the standard. That will be pegged at the 1073, 100. Now, those two values are actually monetary terms in legislation. So what that means is they're never going to change. So for any other government that want to come into and want to change it, there are provisions in the law to change it, but what that means is it's got to go through the Act of Parliament again. So you can't change that with regulation. So if, let's assume a client doesn't have any protection at all, and you've got the max, and you've got 1073, 100 in your pension account, you could take 268, 275 as a lump sum allowance. So under the new framework, we're not looking at tax-free and taxable only. They will only be testing your lump sum, so that's your lump sum allowance. Right. So, which is a bit of a shift, but it kind of works if you look at that under the new framework, and all with the other added complications to it. So, just keeping it simple, two allowances, in 2024-2025 tax year, lump sum allowance.
Yes.
And the lump sum allowance will also have a relationship with your lump sum and death benefit allowance.
Yes.
So you would never be tested if you're taking just tax-free cash, as we know, a lump sum allowance. So that'll be what your pension commencement excess lump sum. That's a lump sum.
Yes.
25% of an uncrystallized funds pension lump sum. So that's the off plus that we call it.
Yeah.
So then if you're lucky enough to have a standalone lump sum, that would also be tested along with the lump sum allowance, we'll call it for short LSA. So then anything you take on that will reduce your lump sum and death benefit allowance by the same margin. It will bring it down. So added complication to it for clients that may probably, hopefully, taking the serious ill health lump sum, that is never tested against the lump sum allowance, but will always be tested against the lump sum and death benefit allowance. Now, they're not trying to kill clients, but that's just the way, because of the value, because you could take all your pensions as a serious ill health lump sum. So reducing it, pegging it to 268, 275 just actually doesn't work under the new medium.
Do you know, Donald, I think it's quite important because for our advisor listeners out there, you produced a video that goes in a bit of detail on this, and I would really recommend them to listen to that if you're an advisor with true potential. If you're a client now, what you've explained can be quite difficult to understand, which is always my bugbear with pensions. Yeah. You have to have a qualification to understand them. So, Craig, bringing you into it, if in terms of lifetime allowance, it typically is going to be affecting clients with £1 million and above in a pension, typically. So, if you're a client that looks like this, what are the things you should be considering now?
So, the way I'd probably surmise Donald's points for clients, putting it as simply as possible, is the lifetime allowance being abolished. The only thing which is remaining is it's a reference for how much tax-free cash you can take. So that's not going to change moving forward. So that 268, 750 is going to be exactly the same as it is now. That's going to continue forever, as Donald said. So again, the lifetime allowance being removed from a tax charge perspective, but it's still there as a back reference for how much tax-free cash you can take. And that's obviously 20% of the old lifetime allowance as it was. So for a lot of clients, the majority of clients, they won't be impacted by any changes. It's only going to affect those maybe higher earners, higher net worth clients. And there's certainly levers you can pull with regards to investing. So a big thing that we've seen historically is clients who are up to that lifetime allowance had maybe frozen any pension contributions. Now for those clients, it's a great opportunity to make use of their allowances and put more wealth in a pension where you're going to benefit from huge tax treatment as you would if that money sat in your bank account, let's say.
Yeah, I think the one thing I picked up from your video, Donald, and in general sort of CPD I've had to do as an advisor since this has come in, is if you've got over £1 million in your pension, you've had fixed protection in the past, which not everyone will know about that, but if you're aware that you've had fixed protection, it's worth speaking to your financial advisor to see whether it's worth you looking to contribute into your pension again, because you've obviously not had that facility over the many years, and it could be a great vehicle for you. So please, this is what I'm kind of saying, is we're here for you. Speak to your financial advisor, speak to the team, and that will really help. Let's move on back to the sort of tax year end. So let's just categorise where we are here. So we'll start off with ISAs and where they are. So first of all, Rich, do you want to explain what tax year end is and when that happens?
It pretty much is a time to utilise your allowances, and up until 11:59 on the 5th of April, that's when you have time to utilise those. I would probably try and say, even in the new tax year, get on the forefront and get prepared, because it can get very busy at the end of the tax year. Rushing around, everyone's busy, utilising those allowances, making sure you're contributing to the policies that you need to be. It's a deadline day basically.
I've had clients ring me on the 5th of April that I need to utilise my allowance. How do I make sure I do this? And it's just always a last minute thing. But let's talk about those allowances. So your ISA, Craig, roughly what can we put? Not roughly, exactly what can we put into it?
It's £20,000, as Donald mentioned. There's scope for that increasing next year. Certainly the budget released that, but £20,000 your ISA allowance. That's very beneficial for clients who hold maybe wealth with us already, whether that be in like a general investment account, let's say. Obviously, within your general investment account, you're going to attract tax, CGT, and income tax, or dividend tax, depending on how that income is drawn. Whereas within a pension, that's within an ISA, that's completely sheltered from gains and income tax or dividend tax on withdrawals. So it's fundamental that clients are making use of that £20,000 allowance where possible.
And I think one of the points I would make is if we had this conversation or we had this podcast a year and a half ago, we probably wouldn't be talking around bank accounts with high interest rates, but obviously they're attractive at this minute in time. You're seeing rates, 4% plus. Just be aware that if it's not wrapped in an ISA and it's just in a bank account, then that is subject to tax that you have to put on your tax return.
It's not tax efficient at all, like you've just said it. And what to point on what Craig said in terms of the allowance as well, he talked about dividend allowance. So for next tax year, 2024-2025, dividend allowance is going down from 1,000 to 500.
Yes.
Capital gains tax is also going down from 6,000 to 3,000.
Yeah.
So what that means is your ISAs and pensions have just now become more attractive, really.
Yeah.
To put that on, because you're right. If it's not wrapped within that wrapper within the tax efficient wrapper, you will be capital. It's huge.
Yeah, and I think it's important to mention that. Okay, so that's ISAs. We've obviously got pensions, Donald.
Yes, we've got.
So what can we put into a pension?
So we've got the standard annual allowance for pensions. So obviously it's not all doom and gloom when the budget came out last year and this year as well. So the standard annual allowance did actually go up this tax year from 40,000 to 60,000. So you've got 60,000 to play with. Now you can also use carry forward as well. So where you haven't taken, we're talking about, fixed protections and all, where you've got protection and all that, and you've not been able to contribute into a fixed protection. Now you can make contributions to fixed protection, so that you've got almost £180,000 to play with, pay into a pension. Now there are two angles to that. There was £60,000. Then you have if you've taken, for clients that have taken income from their pensions, especially income, not lump sum, but just an income, it reduces it a bit. But it used to be 4,000, but it's now 10,000 floor. So which is actually, it's called the money purchase annual allowance. So that's good. For higher earners, people earning over £360,000, they also have the same floor at £10,000. But you've got a lot of headroom to play with now. So it's not 40,000 anymore. So in the tax year end that Rachel talked about, so tax year end spans from 6th of April to the 5th of April. So you have a lot to play with. So essentially you can put 60,000 into your account if you have the earning to support it for personal pension, for personal contributions. But employers, you don't have any recourse to that if it's an employer contribution. Yeah. So I would just get talking to advisors now to keep you straight on those ones.
Yeah, good. No, I totally agree. I think this is another key point is speaking to your advisor. If you feel that you haven't utilised your allowance and you can, and we're not saying everyone can put £60,000 in a pension or £20,000 in an ISA every year, but this is allowance you will lose, after this year. So if you can take advantage of putting a little bit in there, then you should definitely take advantage of it.
That's correct.
So Rachel, how do clients do this? So they want to put in their ISA allowance in or their pension contribution. What's the easiest way for a client to do this?
So there is a multiple of options. However, we do have a feature called Impulse Save. That's just for one-off ad hoc payments. It's really simple for a client to do. You log into the web or your app and simply click of a button, enter your details in, like purchasing something online, just like Amazon, you put your details in. If you want to save those details as well for later on, you can. Just say you want to make a couple of ad hoc payments throughout the year, and it's literally just as quick as easy as that.
And as long as you've impulse saved before the deadline date, even though the money potentially hasn't hit us yet, then that's sufficient to utilise your allowance.
Yeah, I wouldn't leave it up until 11:59 on the 5th of April, that's for sure, but I would definitely try and...
I remember when I first came into the industry, and tax year end's always been a busy period, and Donald, you might be the same with this. I'm not sure you guys have witnessed it, but it used to be we'd keep the office open till midnight.
Yes, we did.
And we had clients coming in with cheques.
Absolutely.
That's kind of...
Showing your age.
I know, I am sure my age.
I'm sure it's strange to Craig and Rachel as well. Yeah, but that's what we used to. I mean, 2 a.m., 3 a.m. waiting for checks to arrive. So
it was mad. You had all this. You had a full year to do your allowance and came up with a check.
The big thing of that is obviously the technology we have in place has probably enabled clients to do it themselves, and for all an advisor's there to help you. If you want to put some money in an ISA or in a pension, you want to do that yourself, you've got the capacity to do that through our technology, which is empowering for clients, but also you get more value from your advisor by doing things they can actually help you with, as opposed to helping you cash your check, let's say. So it's been really liberating for the industry.
And just the system, we've always preached that goal-based saving as well, and that's what our system actually allows you to do. So you don't have to wait to the last minute, but if you do, you can get that in easily.
I think what I would say as well, looking at both angles of the clients that are coming to retirement and clients that maybe are accumulating for retirement, if you utilise these allowances on a regular basis throughout your lifetime, it makes the tax discussion of when you eventually do need this money to provide a retirement income, it makes it a lot simpler. In terms of how you can structure it. And I think one of the questions I always get asked is, why an ISA, why a pension? What's the benefit? Let's just talk through that. What benefits of using an ISA, Craig?
Yeah, well, obviously up front it's usually beneficial at face value. So again, I mentioned no income, dividend or capital gains tax within that product. Plus, for many clients, particularly younger clients who are looking to get into investing or putting money away, there's an apprehension around pension investing because ultimately you can't access that pension until minimum pension age, which is 55. It's going to go up to 57. Whereas within an ISA, stocks and shares ISA, you can put that money in and you can access it whenever. So you're getting the ability to tax efficiently save money and invest, but at the same time retaining your access to your fund for what for some people might be 25, 30 years, let's say, particularly younger clients. So hugely beneficial ISAs, and we do recommend for the majority of clients look to utilise them in the first instance, particularly younger clients.
Yeah, and then let's flick over to pensions.
I mean, for an ISA, you have the simplicity and the flexibility of an ISA. So whilst you don't have the flexibility within a pension, you actually do have the terms of gains. So tax efficient in terms of tax-free cash, the tax relief you get on your pension. So and for any £1 you put in a pension, you get £20 out into it. There's no other investment, medium out there that will give you straight up 20%, paid into a pension. But a pension does that for you. Now, a pension is also, essentially it's a retirement savings plan. What that really does is actually forces you to save for retirement. What you don't want to do is leave your retirement, so you have something to fall back on if something happens, if something happens to you, and that you're also, apart from, apart from, you have something to fall back on when you retire. A pension also allows you, give something to your beneficiaries as well, your dependents and all that. If anything happens, if you're deceased or anything. So, I mean, for me, it's a, we normally would say, is it a pension, is it an ISA? Why not just do both if you can? Because you've got allowances on both. So for short to medium term savings plan, ISA, you can go in. For a long-term savings plan, bring in a pension and let it do the work for you as well. And
I think, Donald, one of the big things a real success story in pension legislation over the last few years is auto-enrollment to me.
Absolutely.
Which is effectively got a huge amount more savers across the UK into pensions and got people thinking about, why am I saving for a pension, etc. And I think that's really key. The majority of the UK population probably will have a pension now.
That's true.
And I've always said is that the earlier you save, the easier it is because of the compounding effect.
What I would say to that, from an advisor angle, is if you can make it a behaviour. So auto-enrollment's by default made it a behaviour of people to invest money by doing it self-consciously. So similar to what you said with your allowances before, if you get into a habit of utilising your allowances on a yearly basis, it almost becomes second nature and you just do it by design. And once you become a behavioural investor, do it on a regular basis, that's when you see the huge benefits of investing over a long period of time, not only from a growth perspective, but also, if you mentioned during the accumulation phase, tax efficient savings for you immediately now, but also when you come to withdraw and accumulate your funds later in life. So, yeah, again, we've mentioned it many times, the earlier, the quicker and the more regular you invest, the better you're going to be over the long term.
Yeah.
And it's a good habit to have. We talked about it. The more you impulse save, you can do direct debits as well into your account. So once it's left your account, we talked about it, so many colleagues have done that as well. Yeah. Think about it as a bill. That's what we used to talk about. Just once it's left your account, then you're not thinking about it, but it's there, it's working, that your money is working hardest for you somewhere when you need it. So that's crucial.
Agree. I think we've missed probably missed out other products, but I think the main product is the junior ISA, which we should talk around that, shouldn't we? Craig, do you want to tell us what the allowance is on that? Yep,
so it's £9,000 for your junior ISA. It ultimately allows you to, again, tax efficiently invest money on behalf of a child under 18, so that they can have some money when they maybe get to 18, they want to buy a car, they want to go to university. You've got a kind of nest egg invested for them in a tax efficient manner, which you can subsequently pass on. It's good for getting money outside of your estate as well. If you're an individual with a higher net worth, it allows you to invest, take the money out, so you're not going to fall within your parameters. But it's just, again, another behaviour of investing money for somebody else who you're closely connected with.
Brilliant.
And one of the merits, again, we were just talking about the out of estate, one of the merits of holding a pension is anything in the pension is out of your estate as well.
Yeah.
So for IHT purposes, you're safe.
Yeah, definitely.
So
I think that we've done a couple of podcasts in the past on that, so worth going back and listening to that type of thing, because there's some real big advantages of ISAs versus pensions and vice versa. So thank you very much, everyone. Useful session. I think, let's ensure that, if you do need help as a client, we're here for you. Speak to your financial advisor. I think it's important that you do utilise these allowances. We've only got a few weeks left, so please do. If you do need our help, just let us know. And thank you, everyone. Thank you, Rachel, for your first one. Thank you, gentlemen. And thank you, everyone, for listening. Please, if you do like the content, please do like and subscribe. Thanks, everyone. Speak to you soon.